VeChain and particularly Fed now offer something which is most rare in today's economic environment, namely an asset which actually produces an income. Over the last year, something incredibly important has happened in the money markets around the world. The base rate of interest, which is the rate at which banks can borrow from central banks, has been cut in response to the coronavirus pandemic. And what this has meant is that there is no longer any income to be had on short-term government bonds or fixed-income debt investments. And even long-term debt investments like 30-year US bonds offer a rate of interest, which is actually lower than the rate of inflation, meaning that they still lose money in real terms. The world has gone mad, and it seems as if central banks and private fund managers are lining up to lend money and take on the risk of default and the associated cost of creating lending contracts, and all for free. Central banks in Switzerland, Japan and Denmark are all offering to pay people to borrow money, while here in the UK the Bank of England is charging just 0.1% and the US Federal Reserve 0.25%. And what this means is that the age-old and what we all thought to be evergreen methods of asset valuation have been turned upside down by a situation that no great economist ever considered to be a possible outcome until around 10 years ago. Before that, going back 1,000 years, the way to value an asset was very simple. If you could borrow at 5% and buy an asset which produced a steady 8 or 9%, it was generally a good deal. And of course there was a lot more to it than that in terms of actually finding the investments and then figuring out what they will produce in the future, and securing the financing and so on. But the basic principle was very simple. If you could cover your cost of financing, namely the rate of interest that you were paying to buy the asset, and then you could make a small profit on top, it was usually a good deal. And by the way, if you're enjoying this video so far, I want to ask you to help me out and subscribe to the channel, as you'd be allowing me to spend more time making videos like this. So anyway, now that central banks are borrowing and lending money for free, how do you value an asset? Take this as an example. Let's say on the one hand we have $1 billion worth of government bonds, and on the other hand just one share of Coca-Cola. Now the government bonds may earn nothing at all, as 0% of $1 billion, or indeed any figure, is still zero. But the single Coca-Cola stock may earn $1 or $2 per year in dividends and retained income. So which one is actually worth more from an income-based perspective? And how do you value an income-producing business or currency in an environment where there is an effectively unlimited supply of almost free money? The truth is, what we are seeing today in the stock market and in real estate and crypto in terms of continually rising prices is simply a function of a broken economy, where there is an unlimited supply of currency that can be borrowed for free to purchase income-producing assets, meaning that the premium placed on cash flow-producing investments is exploding. And VET being a cryptocurrency and one of the few which produces an income that is derived from actual genuine usage and not entirely from speculation, has been booming as well. People complain that VeChain is earning only a half of what it was this time last year from a yield perspective, and as prices have risen so much, naturally yields haven't been able to keep pace. But the thing is, there are professional investors representing money management funds and wealthy clients who are borrowing for almost nothing. And this distorts the market's natural mechanism for establishing fair valuations, as again, if there is almost no opportunity cost of borrowing money, does it really matter how little income an asset produces? To be honest, I'm not sure. All I know is that people are still borrowing money for a fraction of the available yield of cryptos like VET, and people are also talking about the crypto market being in a bubble, a term which refers to a situation where asset prices are unsustainably high. But the thing is, when interest rates are zero or a hair's breadth above zero, and there is no opportunity cost of borrowing money, where do you draw a line between a bubble and non-bubble territory? There is no clear line, and I for one have a theory on this subject, and that is if we continue to see interest rates at nearly zero, potentially even lower, and more money being printed and pumped into the economy, which hasn't been legitimately earned or taxed, but simply created out of thin air, no different to throwing bags of money from helicopters, the market value of cryptos like VET and businesses and apartment houses and all of these assets which create and produce a real cash flow will just keep rising and rising in dollar terms. The real question is, how much will the dollars being used to buy VET be worth in real terms of purchasing power? But anyway, in pure dollar terms, the value of income-producing cryptos has no clear limit. Remember that interest rates are the gravity of asset prices. The higher the interest rate, the less things can rise before they fall. But when you get rid of gravity, effectively the age-old principle of things that go up having to come down may not be so true anymore. And I for one think that if interest rates continue at similar levels, which may be the only option for central banks given the high level of government debt that countries have around the world, VeChain, being a high growth and income producing crypto, will likely continue to rise in value a long way from here. Anyway, that's all for this video. If you enjoyed and you'd like to see more content like this in the future, be sure to subscribe to the channel, and thanks for watching.